we begin today. Greetings, traders. It is I, Abdul Shabazz, and this is Some Real Change Stock Options Trading Journey. And today, this terrific Tuesday, I can't do anything but thank you guys for being here. Thank you for being here. Very exciting day today. Very exciting day today. Please feel free to share your plans. Identified this controlled buying algo this morning coming out of pre-market. What's this? I like the 654. Okay. I'll just take this out. Okay. All right. I like that. Those are my plans. Those are my plans. This is what I saw here. I need to adjust this. Team is in the building. Shout out to the team. Let me get my laptop together. Action is taking place early here. But we're just coming down to the bottom of that control buying algo. So there was a control buying algo identified pre-market. Let's just pull up the 5-minute chart right now so we don't become overwhelmed with everything. This is what we should be looking at and focusing on right now, team. First 5 minutes, very volatile. The first 15 minutes can trick you, which is why we give the market time. That's exactly why we give the market time. Shout out to the team for being in the building. And Kosi, Todd Macon, Jesse Swanson, Brooke Sanchez, BFH is in the building. Shout out to the team, Kick, who is also in the building, kicking it with us as well. So grateful for you guys. Thank you for following us on Kick. And thank you for subscribing on YouTube. Dollar bill, y'all, is in the building as we coming down to the bottom of this control buying algo. Look for bulls to step in right here at this area. If they do, great. If they don't, it doesn't matter either way. Nice plan. Be patient. If anybody has any plans they would like to share, please feel free to put them in the chat. I have my alarm set in my areas of interest, the areas that I would like to take a trade at. I'm just going to be patient to see if the market comes down to my areas of interest. Keep in mind, first 5 minutes very volatile. The first 15 minutes can trick you. Have you thinking the market's going one way and then completely go in a different direction. Part of my system is to give the market some time to reveal itself to you. I've been on a 20-day commitment in trying to achieve that 1% better. I've challenged myself for 20 days, which is an entire trading month. For 20 days not to take a trade before 10 o'clock. And I have so far been successful. Having a great month, being patient. And then now I will compare that to next month if I choose to become a little more aggressive. If not, I might just stick with that, because there are times, and where I do miss some scalps, like right now. But what I like about me being on here is that when I do the trades that I take, I try to make it so that if you understand that trade as well, that we all can get money on that. The scalps that I see, if I just hop in those scalps, and someone does try to hop in behind me, if you don't understand the setup and the quickness of the execution of it, I can make profit and you can lose profit, and I don't want to do that at all. So I'd rather let that trade go by and find a trade that we all can get money on. So it's just what I'm doing. So that does mean that there will be some times when like right now. But the discipline. Dr. JB, 658 puts. He is out 25 lots, 1850 made already. Shout out to you, Dr. JB. He murdered him. Thank you, Dr. JB, for getting us fired up, getting us inspired. I'm just now cutting my laptop on. As the market gets back to my area of interest, the bell went off and it bounced from there. So all I'm going to do is just reset the alarm and continue to be patient. Know what I want to see. Be grateful if and when it comes. Alarm is reset. absolutely there. Well played, Dr. JB. Jared Lewis is building. Good morning, Jared Lewis. Market coming back to my area, and this time I will be waiting, see if we get a close. Gonna move off of FOMO. My goodness. Came to my area, but I did not take the trade. Oh, I'm feeling it. I'm absolutely feeling it. Being patient though. That's what patience gets you. You don't chase, you don't get burned. Yeah, it hurt. It hurt to watch it go by. It did. But the discipline is what I'm after. The discipline. The market has to move. Shout out to those of you who made money on that. We got some great traders on here. Beautiful scalp opportunity was absolutely present. Shout out to those of you who made money. No, you did just right, Dr. JB. As Brooks is saying, Powell speaks in 2 hours, 30 minutes. Let me look at that. I forgot to look at the economic calendar. Shout out to our teammates, though, who got some nice money on that. Doggone it, he does speak. Wow. Good call, Brooks. Powell speaks at 12 o'clock. Wow. Okay. We'll see. But I mean, you know, it's never the news. It's always the reaction to the news. So all we got to do is just be patient. I still like my put. I'm just grateful for this bounce because this bounce is going to give me more liquidity. You know, and a stronger put when I do get back in it. This is probably just making a higher low. We shall see. But now with the knowledge of Powell speaking, I don't know. But I don't know. Because sometimes you get in, get your money, and be gone like Dr. JB even before Powell speaks. But me implementing my system that comes with the trader checklist. First thing it tells me is, Abdul, do not trade before 10 o'clock. Allow the charts to form. Does that mean there's going to be some times I'm going to be sitting here sick? Absolutely. The one thing that I've learned is that people are not successful. The system is successful. Therefore, people who follow the system are successful. Your discipline in following the system is what makes you a winner or a loser. If intelligence were the key, there would be a lot more people making money trading, and they are not. And they're not. Exactly what I'm looking for. A nice bounce here, possibly putting in a lower high. Looking to get in and join my teammates in this put if and when it presents itself. In the meantime, I have reset my alarm. Not allowing myself to be drawn in from FOMO. Sticking to my plan. Slight adjustment will be made on the entry. Slight adjustment will now be made on the entry. We'll go 653.7. No ad. Boom. Leave it like that for right now. Possibly trying to grab this lower high. Could potentially be a nice short here at this lower high. For this potential lower high and an opportunity in this trade. Be patient. Continue to be patient, sir. Scalp 657 to there. Scalp. Nice call scalp. Nice call scalp is on the horizon. Nice call scalp. A lot of liquidity right here. Still looking for that lower high. Showing my trading view algos. While I'm still on the side right now, I want to really take a put below here, which is ideally for me. And I would like to grab a call if we come back in the 660 area. So the market has to move either way. Anything between that is scalps. Nice call scalp is on the horizon right now. Just broke that control selling algo very beautifully. Very beautiful. Nice call scalp. Headed back towards that larger controlled buying algo. Beautiful move by the bulls. You got to be real quick, like Dr. JB, to make some money off that put this morning. Like Dollar Bill to make some put off that morning. You got to be real quick. Loving my patience this morning. What I tell you, first 5 minutes can be very volatile. What did I say after that? The first 15 minutes can trick you. Have you thinking the market is going one way and then completely go another direction? Give the market some time. And I promise you, we will pick some profit out of it. Right back to that control buying algo. But what are we gonna do here? Well, I guess we'll find out shortly. Beautiful. Could this be that lower high that we seek? Could this be? Could this be? $15-minute chart, bottom left. 30-minute chart right here, smack dab in the middle. Looks like a beautiful washout long, attempting to set itself up on the horizon. Dr. JB getting them going the other way. Dr. JB said, almost made his daily goal. Let's go, Doc. You can do it. A lot of time left in the clock, as the day has really just begun. 10 o'clock is upon us. 10 o'clock is upon us. And looking at the daily candles so far, daily candle was showing us pretty much just a hammer hanging out down here. Found some support at the 653. So buy the dip, came in and started buying the dip. So even that hammer is still a small form of indecision. On the 30-minute chart, we have the exact same thing. A beautiful washout long potentially could be on the horizon if we get over the 6575. That'll be a beautiful washout long as this candle was red. We had teammates make money on the way down and on the way up. Market still in a state of indecision, so if you hasn't taken a trade right now like I haven't, don't feel bad. You've absolutely missed nothing. You missed nothing. Let's take a look over here at the 15-minute chart. For those of you who love the ORB, you've missed nothing. Be patient, and consistency will get you to the level of our more elite traders on here. That's all you have to do. Be consistent at your level, and eventually you will graduate as well. Remember, do not compare somebody else's chapter 8 with your chapter 3. Be grateful where you are. Enjoy the view at your level, because as we ascend, you will not see that level again. So enjoy it while you're on that level, and then soon you too can look forward to making thousands of dollars a day, inshallah. The market is attempting to go from red to green. That will take place here at the 657. And we just got to break it at 657. The market is now green on the day. The market is now green on the day. Grateful for that, but the market still has not yet reached my area of interest. So I am not in the trade. Beautiful washout long on the horizon right now. But I myself am going to be just a little more patient. You know what I want to see when I came into the market? And I'm not going to allow the market's action to sway me away from my already predetermined plan. I want to make as little decisions as possible when the market is open. The main decision I have to do is what am I going to drink for my cuppa as I wait for the market to come to my area. I'll be back, guys. BFH with the humor. Getting closer to my area of interest. Very important. We see what happens in this area. Being patient before I make a decision to get in or not. Closer to my area of interest. As I showed you guys earlier this morning on my trading view chart, very, very interested in the 660 area. Looking to see if we're going to get a close here and then a continuation candle. Being very patient right here. We were not able to break out of this controlled selling algo. We came right to the top of it. Right to the top of it, but we were not able to break out of it. The market is retracing temporarily right now. We're about an hour away from Powell speaking. Thank you, Brooks, for reminding me of that as well. Thank you for reminding me of that, Brooks. No, sir, BFH. There is no death candle anywhere on this chart. Not in today's actions. No, sir. We're green for today. We had a beautiful washout long, which is what we had. It took place on a 30-minute. So if you look at the 30-minute candle, 30-minute candle shows you a beautiful washout long. Shout out Mad Ass. Turned this beautiful big red candle into a red hammer. And then we had trading above that on the 657, as I also called that out for the team earlier. For those of you that want to take that scalp put after that beautiful washout long presented itself. Wa alaikum assalam wa rahmatullahi wa barakatuh. Sister Lady Khadijah Quill is in the building. And so now didn't quite get to my area, the 660.5. You see I have an alarm there. That's my area of interest. That's where I want to get in at. So I'm being patient until then. You know, I always set my alarms and I ignore the noise. goes on in between. I do realize that the market does have to move even in order to get to my desired area. But I'm disciplined enough to wait for that until I decide to take a trade. Very beneficial news that Powell is speaking today. I do have to take that into consideration because you guys do know what Powell does whenever he speaks. In case you forgot, it is a great time for me to remind you simply by going to one of our sponsors right now, Shirts for Traders. You're a trader, right? Then look like one. Some of the finest quality shirts on the market available today. Simply head over to Shirts for Traders. Please don't forget the S. Again, that's shirtsfortraders.com. There you will find some beautiful trading shirts that allow you to represent how you feel as a trader for that day. And what else better to sum it up than with this beautiful shirt by Jerome Powell. In fact, the shirt is entitled Pretty Much Sums It Up. Head on over there now. Fast delivery, great durability, and look good wearing it while you represent what you love to do. Again, that's shirtsfortraders.com. Alrighty, traders. I am remaining patient. I went ahead and kind of blurred out a little bit of that. Matter of fact, I'm going to just take it off. That opening algo. Bam, I'm just going to take off the chart right now. And let us deal with what we have to deal with right now. And that is a countdown to Jerome Powell speaking. Let me go ahead and blow up this 5-minute chart. Is anybody looking at relative volume right now? It does look like we have appeared to have fallen off a little bit as we get closer to lunch. Oh yeah, volume has really fallen off. Has fallen off. Not quite sure if I want to eliminate pre-market, but I'm going to do it anyway. Let's go ahead and get rid of pre-market. See what the market's looking like. Give you a much broader view. Bam, there we go. Aha. Now we can keep things in their proper perspective as far as the area that we're currently in right now, and how much more are we really seeking in a call with clear overhead resistance. Clear overhead resistance. Brooks Sanchez says around 40 mil in volume. Thank you, sir. Again, a lot of people might just be waiting for Jerome Powell. Again, you know, around 11 o'clock, I sign off anyway. It is time to go to the gym and for lunch. But I will be back as Jerome Powell speaks. Brooks, what time is he speaking, sir? Oh, I'm having mixed emotions. This is the area that I want to get in. But I'm going to be patient. What time is he speaking, Brooks? We'll have that queued up for the team. 12 o'clock, 1 hour. Hour to the countdown. Well, I'll probably just go ahead and let them take over for me and turn the channel over to them. See what happens after he speaks and then deal with it. We find profits in the charts every day. It doesn't matter how the market moves. We're grateful enough to be able to have that skill. So let's just be patient and see what he says and then make our move. So with that information, Dollar Bill says 12.20. You got the opportunity to make some money before he speaks. As Dr. JB had a great day today. knocking down well over $4,000 early this morning. Shout out to Dr. JB. Shout out to Dollar Bill getting to the bank. Shout out to Brooks Sanchez getting to the bank. BFH getting to the bank. It's a beautiful thing. It's a beautiful treat when traders meet. It's such a treat. Yes, sir. So I think I'm gonna go ahead and fade out, fade back, allow this to do what it does, but keep in mind this clear overhead resistance and just ask yourself, is the risk worth the reward? So you gotta ask yourself. You see the volume is getting low. Why are you trading? If everybody else is waiting on Powell, what are you doing? Just keep that in mind as I get ready to search for him right now. I will be pulling up CNBC for a live broadcast.
Not make mistakes too, so we'll see.
Of course, shares. First place year-to-date performance this year, but they had the best 3Q in each of their five operating divisions during the quarter, and they've been making sequential improvements throughout. There was a little bit of accounting confusion surrounding the sale of 25% to its Banamex subsidiary. That's the Mexican subsidiary that they're looking to fully divest. So that led to a little bit of accounting irregularity as it pertains to EPS. Ultimately, ruled a beat there relative to expectations, and their net interest income continues to do well in terms of Citi there. So positive quarter for Citi. Wells obviously getting that boost from increasing its medium-term targets for its return on tangible common equity to 17 to 18%, which is a remarkable turnaround for that company as well, considering that figure, that metric was about 8% in the fourth quarter of 2020. So you're looking at more than doubling it over a 5-year or beyond span, depending on how you define medium term.
Yeah, not to mention Sharf's comments just now about pretty good credit quality, no deterioration in autos, something to watch, and one reason they're leading the S&P. Leslie, thank you, Leslie Picker. For more on the market's reaction to the banks and some new trade headlines, CNBC senior markets commentator Mike Santoli here at Post 9. Is this classic sort of bank price action in the wake of earnings?
For sure, with an instinct towards sell the news. I think the macro message from the banks is either reassuring or certainly nothing incrementally worrisome. But yeah, they run up, and then, a lot of times when we're talking about capital markets revenues, investment banking revenues, they're just not that easy to extrapolate as a trend. So people say, great, it's money in the bank, literally, but it's not necessarily the new run rate. That being said,
I did follow my plan.
Talk about textbook.
I did follow my plan, getting in the trade.
S&P 500 this morning.
Exactly where I wanted to get in according to my plan earlier. Taking that 660 call, we'll be shooting for a profit target of 663.
The same kind of lower quality, highly
and then possibly 661, and then possibly 666.1.
We've talked about it for weeks, that's been this very strong flow of speculative energy in that area. Today, it's more defensive quality.
I decided to trade my plan regardless of Powell.
Opened up the window for a longer period of choppiness and figuring out whether the pressure
team already told me what time he's speaking.
The inability of regional banks to really lead again. even industrials have stalled out. If that's telling us something or if that's just kind of a stutter step here.
Right. This Walmart news is interesting. It's leading the Dow. This partnership with OpenAI and ChatGPT. I mean, 3% move in Walmart's nothing to look askance at.
It's not. I mean, maybe it does just show that, hey, we're just going to surf to the next proxy for the only trend that matters for a lot of investors. It also, though, it has a huge overlap with the quality, lower vol trade. So Walmart would be a beneficiary on a day like today anyway. So, look, we'll see. I mean, the trade stuff matters, but I think it's much more in the sense of a reminder that it's not all about a fourth quarter performance chase that was going to get us higher. And it complicates the idea. I think Wall Street craves a clean 2026. They have this sense out there that we have some of the tax provisions kicking in. You're going to anniversary the tariff stuff. We are going to have earnings growth. You're going to see more rationalization along the AI tech earnings front. And they just want it to be clean as opposed to contending with a lot of the issues.
Alrighty, so I am in place. My trade is on.
Soft labor.
I've done my job. I'm now going to let the market do its job.
Economic
Check back with you guys.
The fact
Yes,
that
sir.
Going to be in
Check
this
back
with
with you
China
guys
for a while,
when
perhaps,
Powell speaks.
is working against that idea that it's clear sailing into next year.
Yeah, well, we'll see if we move closer and closer to a would-be meeting in South Korea. Mike, thanks. Mike Santoli. Mina, as we're talking, we're getting some Boeing orders and deliveries. For that, we'll turn to Phil LeBeau. Hey, Phil.
Carl, for the month of September, Boeing having another successful and strong month, which is what they've been trying to build. One successful month after another in terms of orders and deliveries. Orders coming.
power. Every core computers now have primary control of critical vehicle functions.
To look at what you hold in your positions and say to yourself, what's your leverage on your positions, and can your positions be used as a source of liquidity? It's interesting because all year people come on the network and they talk about owning quality. Well, guess what? This hasn't been a quality rally in 2025. This has been a momentum rally. This has been a crypto rally. This has been an AI adjacent rally. And in some areas of the market, it's a junk rally. And yesterday was kind of evidence to that. Today, we're making a little bit of a turn. So what do you do with all of that? I think you say to yourself, look at the positions that I have. And maybe as it relates to AI, we know that OpenAI is touching all areas of technology and the semiconductors and various parts of the economy. Maybe I'm not throwing any more money at that. Maybe this is the right moment to step back and say, okay, I'm long. Everyone else is long. Let's sit tight on that. Maybe it's an opportunity to look at some other areas of the market where you could rotate capital accordingly, like some areas of healthcare, like some areas of the financials, like some areas of the market that have been unappealing so far 2025. And I think in doing so, you're kind of reshaping your risk.
Yeah. Well, speaking of alts, which is the topic obviously here in Beverly Hills, they're booming. You know that. Case is a platform, by the way, that connects some of the world's largest alternative asset managers with investment advisors, and there are many here. Robert Frank joining us now to go inside this investing phenomenon. Robert?
Scott, great to see you. And as you say, alts are booming. They're also one of the most misunderstood, confusing, and complicated segments of investing right now. Now, the term alternatives refers to basically anything that's not a publicly traded stock or bond. So that's private equity, it's private credit, it's hedge funds, it's venture capital, it's real estate, it's gold, it's crypto, it's art, all the other collectibles. Now, if you look at where this has been popular, the wealthy have been adding to their exposure to alts for decades. So it, like I said, typical U.S. family office has about half of their investments right now in alternatives, about 25% in private equity, 20% in real estate, all the rest in those other asset classes. Now, the theory is that alts generate higher returns and lower volatility in exchange for lower liquidity. But by many measures, the median returns for private equity, for instance, have lagged public markets in both the short and the long term. Now, family offices have actually been adding to their public stocks recently, due mainly to AI. And since they can't get money out of private equity, they're putting less money into private equity. But now that IPOs and exits are coming back, those returns for PE may improve. The amount of capital going into private equity has increased by tenfold since the financial crisis. And the total investments right now in all alts expected to hit $29 trillion, Scott, in just 5 years. That would be double what it was in 2022.
Wow. It speaks to, it's really great setup there for us, Robert. It speaks to why we now have an Inside Alts newsletter with Robert Frank. I urge everybody to check that out. Some of the world's largest asset managers are here at the CASE conference. They want to make their products more accessible to you, to retail, to investors like all of you. Leslie Picker joining us now with more on that side of the story, following the money as always. Leslie.
Hey, Scott. Yeah, call it the retail revolution or the democratization of alt. It's one of the biggest untapped markets for asset managers right now. You just heard Robert Frank give those statistics about how fast the industry is growing. Well, retail investors' allocations to private capital are projected to grow from $80 billion today to about $2.4 trillion in the United States by 2030. That's according to Deloitte, which defines retail here as those deemed non-accredited by financial regulators. That includes individuals with net worth under $1 million, excluding their primary residence. There are several different types of vehicles that give retail investors more liquidity than a traditional alternative asset fund. However, usually these come with extra layers of fees relative to institutional funds. And Moody's recently warned that these funds designed for retail, while growing in popularity, could create broader risks for the U.S. economy due to some of the illiquidity concerns there. Full coverage from myself and Robert Frank, of course, can be found in that monthly newsletter that you mentioned. You can subscribe using the QR code on your screen to the right there, Scott.
Yes. It's a dynamic duo, you and Robert, and Inside Alts. And I urge everybody to check that out, really, if you want the inside scoop. Leslie, thank you so much. The bottom line is that the 60-40 portfolio has changed so dramatically. It says everything to me that your firm and, your NB Private Wealth, that you guys are here. You want a piece of this action.
Yeah, I mean, I think at Neuberger, what we think about, Scott, and actually what we've done for clients for many years is think about this as a continuum. Private equity and private credit are just part of your equity and fixed income allocations. And increasingly, they're a big part of that universe. If you think about the decline in public companies that are listed, if you think about the increase in those private credit, I mean, we've seen loan growth decline significantly since 2010 for traditional financial institutions. And so in order to create a larger investable universe and really capture the full universe of equity and credit, you need to have allocations within private markets. And so I think it's a little bit less about thinking about this as an alternative and more about thinking about on that continuum, if you are especially with a longer term time horizon, you can put some of these assets into these aspirational categories that can grow over time.
Okay, and we have some big interviews coming up, as we said, to give you a little more information about the whole alternatives landscape. We're just getting started here at the CASE Summit. Coming up next, Franklin Templeton's the CEO, Jenny Johnson. She'll join me live. We'll get her take on the alt boom and so much more in these markets. And coming up later, as I said, Oak Hill Advisors, Glenn August. He'll give us a pulse on the credit market, which is, as you know, a hot topic everywhere. We're back in 2. Welcome back. We do have some breaking news from the Fed. Chair Powell is speaking right now in Philadelphia. Steve Leisman, our senior economics reporter, has the headlines for us. Steve?
Thank you, Scott. Yeah, Fed Chair Jay Powell addressing the NABE annual conference says the outlook for employment and inflation has not changed much since September, and the Fed is indeed looking at a wide range of private and public sector data with the government shutdown and the absence of that government data. The downside risk to employment, he says, as before, has risen. Downside risk has risen, and the data prior to shutdown showed the economy was on a firmer path. We may approach a point, he says, in the coming months where the Fed stops reducing its balance sheet. There are some signs, he says, of liquidity conditions tightening. The Fed portfolio, he says, is overweight long assets, underweight short-term assets, so maybe some change coming in the way the Fed does it. Fed's going to review the composition of the balance sheet. Fed will lose control over the rates if it could not pay interest on reserves. And he said we could have and perhaps should have stopped asset purchases sooner. Scott?
Steve, I'm interested especially in what you just said about what the Fed chair is saying, that some signs of liquidity conditions tightening. And I'm wondering if you can expand on what you think he's referring to and whether in any way that's some of the issues that we're all watching in the credit markets are certainly getting the attention of central bankers like Chair Powell.
I don't think it's these immediate issues. I think he's referring to an event we had, I think it was about a month ago or several weeks ago, Scott, where there was a surge in repo rates and some other signs of tightening in the credit markets. I believe it happened around the quarter end, so that would have been the end of September. So, yeah, just a few weeks ago. And there was some signs there. And the Fed has been monitoring other things that have suggested that they're getting close to this place where they want to have ample reserves out there, not too much and not too little. And so what they're talking about now is perhaps ending the balance sheet runoff and then obviously having a discussion about what's in the balance sheet, which may involve reducing the mortgage-backed securities that it holds and also changing the duration. They have, he said, they're long duration and they're short-term notes. And just one other thing, Scott, about his outlook on rates. He doesn't say which way he thinks rates ought to go, but to the extent that he harkens back to the time in September when they talked about the shifting balance of risks, that downside employment risks have increased, it does kind of suggest that the Fed remains on a path of cutting rates here. Looking at the probabilities earlier today, Scott, we were priced in fully for September rate cut, an October rate cut, and one in December as well.
Okay, good stuff, Steve. Thanks for the clarity on that. You'll let us know what else the chair says. That's Steve Leisman, as we said, watching Chair Powell in Philadelphia. We're going to start with the Fed, the reaction to it. Franklin Templeton CEO Jenny Johnson is with us live here at Case. It's nice to see you. Welcome back.
Great to be here.
The market seemed to move up a little bit. You think that was on the notion of ending the runoff on the balance sheet? I mean, what did you make of the brief, at least, headlines that Steve was able to give us here?
You know, actually, let me step back for a second and say, all right, so we all know the Fed has two mandates, employment and inflation. So let's just look at those. The Dallas Fed last week came out with a really interesting study that I don't think has gotten enough coverage yet, where they basically said, hey, look, pre-COVID, the monthly equilibrium of jobs that had to be created was about 100,000 jobs, right? COVID, it went to 250,000 jobs. They actually said, we think that number is closer to 30,000 jobs a month to have equilibrium and unemployment. So everybody is seeing the lower jobs numbers and going, oh my gosh, this is a problem. They said, look, labor participation rate is down. Demographics have changed, and immigration has reduced. You had 3 million people immigrating. Now that's down to below 1 million people just 2 years ago. So one is there's less people that need a job to be at equilibrium. Well, how is it that that's okay for companies? Productivity has gone up 1%. For a decade, it was 1.5%. Now it's 2.5%. There are 156 million workers in the U.S. That's like 1.5 million less people needed to retain the same productivity. It actually feels like the labor market is okay, right? And you talk to restaurants and say, are you having an abundance of applications for people for jobs? No. And then the other thing that I think is lost a little bit on the inflation side, look, tariffs are inflationary. February next year, there's going to be $150 billion that are going to be handed consumers in tax refunds because of the SALT, as part of the big, beautiful bill. Think about how that stimulates the economy. So I look at it, and I think we think that the market is a little too bullish on their thoughts of 100 to 125 basis point cuts, you know, in say the next year.
Nonetheless, though, it sounds to me like you think because of both financial and monetary, fiscal and monetary policy, that you're pretty bullish. It sounds to me.
I'm pretty bullish. Yeah.
And do you think there's an AI bubble? Like, how are you thinking about that question? Because that seems to be hanging over this market now.
Look, bull markets are never linear, right? It's you know, 2 steps forward, 1 step back, 5 steps forward, 2 steps back, right? Like, so we're in some of a little bit of a correction, but I look at it and say, look, I mean, I think the S&P is up 12.5% year to date, and the NASDAQ was up like 17%. I mean, it's been a great year. It's not surprising that you get times. Look, we're having the discussions on tariffs with China, right? I mean, this is all noise. It's going to affect you in the short run. On the other hand, I believe we are in early innings on what AI is doing. The picks and shovels, maybe that's somewhat more expensive, right? And the chips and the investments there. You still haven't even begun the investments that are going to need to happen in power, the grid, let alone how companies are actually getting advantages from AI. Honestly, most companies are just right now trying to figure out how to use it, and they're slightly improving things they already do. You're not getting it. It takes time for that to actually work through and actually impact companies' margins.
Is there a message in the run in gold? I mean, what's your view on that? Because it's been so astonishing, straight up and to the right. We'll show the chart as you answer that question, but what do you make of that?
Well, you know, first of all, we haven't really talked about it. If you talk about the kind of the bear case here, it's U.S. deficits, which are really a concern. You have to have a strong economy to grow to actually deal with some of these deficits. And I think that people worry a bit about inflation, and gold has always been sort of viewed as a hedge to inflation. So I think that actually, I think, supports kind of the case that we still have a pretty robust economy here.
So we're visiting with you because you have made a larger play into the alts universe, and that's what this conference is all about. We're trying to educate our investing viewers on how they should be thinking about what the portfolio of the future looks like incorporating alternatives. I mean, how much do you think, and how much are you advising clients that they should have allocated to alts?
Yeah, so we have about $260 billion of our $1.6 trillion in alternatives, and you know, our view is institutions obviously have been leveraging alternatives for a long time. They are illiquid. That is the message. Like, these are illiquid,
needs to be
right?
Yelled from the mountaintop, right?
Exactly. But you get a premium for that illiquidity, which is significant in a person's retirement plans, right, and their savings. So look, I think some individuals will get their alternatives exposure simply in an allocation, say in a mutual fund. Franklin's Equity Group is doing late-stage venture for over a decade because the old IPO kickers that we used to get have not happened in the same way, and so we started to do late-stage venture. So some of them will get that. Some will move into really these perpetual funds, which are interval funds, which allow 5% liquidity a quarter. And some that have more wealth will go into the drawdown type of category. So I think the good news is there's a lot of innovation happening that is going to allow the average person to be able to access alternatives. And honestly, I always say it's like akin to when my grandfather got into the mutual fund business. The average investor couldn't participate in the equity markets. Right now, the average investor can't participate in the private markets. And with the way that companies are waiting so long to go public, and banks aren't lending in the same way, you need to be able to access. It's a massive opportunity.
I saw a pretty incredible stat. Only 3% on average, of advisor clients are allocated to alts.
That's right.
That shows how big what is already a mushrooming area of the investing universe can grow.
So I think that most folks would say, you know, say in the next 5 years, that number could move up to 10 to 15%. And I think that's right. And I think a lot of that requires the innovation around the vehicles to ensure that it's delivered appropriately so that it's suitable for each client. And that's where we're big believers in the financial advisor. And as Case, as you know, it's built the pipeline to make it much easier for advisors to allocate to their clients. And so the financial advisor really knows what those clients' needs are to make sure that the vehicle is appropriate for each individual client.
I appreciate you spending time with us. We had some nice breaking news for you to react to as well.
Great
Jenny,
to be
it's good
here.
to see
Thanks,
you.
Scott.
Jenny Johnson of Franklin Templeton coming up. Oak Hill Advisors, Glenn August. He'll join us live here in Beverly Hills. We'll get his forecast for the credit market. We'll talk about the Fed as well. Speaking of Chair Powell about to take questions in Philly, we'll take you there live when he begins. We're back in LA after this. Welcome back. We are live today in Beverly Hills from the Case Alternative Summit. The bankruptcies of two companies in the auto sector have heightened concerns around certain parts of the credit market. Glenn August is founder and CEO of Oak Hill Advisors and joins us now here at Case. It's good to see you.
Good to see you.
So you do business in many parts of credit, right? Private credit, leveraged loans.
Yep.
Last year at this conference, I sat here asking people if there was a bubble in private credit. I think it's relevant now to ask you whether we're starting to see the first cracks in that whole story.
I do not see a bubble in private credit. The companies, yes, there's isolated instances. You refer to a couple of bankruptcies. There's always idiosyncratic credit risk. But if you look at where the economy is, if you look at where the equity markets are today, if you look at the balance of where we are from inflation, growth, et cetera, I'd say the backdrop is still reasonably solid, but that's not to say there's not risks in the market. I love Jamie Dimon's comment today that if there's one cockroach, there's probably more.
I was literally going to ask you about that, okay? Because you said idiosyncratic. He suggests maybe not so much.
Well, again, idiosyncratic is a question of how many cockroaches are there. Okay, so if we look at the market today, in the leveraged loan market, in the high yield market, there's less than 5% of credit trading below 80. Generally less than 10% trading below 90. There's really idiosyncratic risk. And where's that coming from? There's issues with some companies that are impacted by tariffs. If you're importing tools from China, guess what? You have higher costs today. Okay, there's impacts of AI. Some companies are challenged on their premise, will AI make them less relevant? Some companies can use AI. And then interest rates have been higher, so costs have been higher. The subprime consumer has been challenged. So there's credit risk. But what I think about is that the credit market is not the equity market. In the equity market, the Mag 7 is 35–40%. In the credit market, there's hundreds and hundreds of companies.
Much deeper.
Each one of them has their own story. And so for people like us who pick credit and have been picking credit for decades, we still see good opportunity, and I don't see a private credit bubble. I don't see a bubble in our markets. That's not to say there can't be a few extra cockroaches around. There'll be alleged fraud from time to time. There'll be cyclical challenges, but by and large, there's still good opportunity in this space.
A few other cockroaches around is different than this being a canary in the coal mine?
That's what I think. And again, as I've been doing this for almost 40 years, you need to really have distress, you need a recession and you need forced sellers. And today, I don't see a recession anytime soon. And the markets have evolved such that the credit markets, there's not forced sellers. There's not that much mark-to-market leverage in the system. The bank loan market is CLOs. The high-yield market is over 50% double B. The private credit market is all bilateral negotiations. So I think there's good opportunity. And as private equity starts to deploy more capital, there's really good opportunity to deploy capital. There's good opportunity for the wealth channel. I saw your previous interview. And again, it does not make sense for individual investors not to have the exposure to alts.
What do you make of this today from Bank of America's fund manager survey? 57% of respondents said private equity, private credit is the most likely source of a systemic credit event, the highest conviction on the source of such a disruption since 2022.
I have looked at that survey for years and normally take the other side of the survey. In my view, what I would say on private equity is that I think returns will be lower. It is more competitive. Interest costs are higher. And I don't think private equity will deliver the returns, which is why so many of our investors are allocating capital from private equity to private credit. I don't see it.
So let's take it from the angle of you obviously aren't too concerned by what you can see. The whole nature of the shadow banking system is what you can't see because it's so opaque. So how do we truly know what is hidden in various places out there that we won't know about until it starts to get really heated up?
There's so much talking about the shadow banking system, but let's put in perspective. When we do senior direct lending and get paid 8 or 9% unlevered, we occasionally, for some of our accounts and funds, will lever that 1-to-1 or 1.5-to-1. That's not 10-to-1 in the banking system. The companies that we're lending to are more than 50% equity cushion. And so again, I think this whole fear is overblown. It's held by long-term capital. We have 8 of the top 10 sovereign wealth funds, 15 of the top 20 largest U.S. pension plans. They are long-term investors, and they can take that illiquidity premium. And so, again, I don't want to say that there's not risk. There is credit risk always. That's why you get paid 8, 9, 10%, or in special sits 10, 11, 12, or higher. You're taking credit risk. You're taking liquidity risk. But that doesn't mean there's a canary in the coal mine and that we're heading towards it.
Lastly, has this forced you, though, to look in your own book and then just go over it once, twice, and 10 times?
We look at our own book every day. Nothing has forced us. We've been looking at our own book every day for 38 years. So the answer is you always have to be on top of what you own every single day.
Glenn, it's great to see you. Thanks for being here with us. It's Glenn August of Oak Hill. Chair Powell is taking questions now at the annual NABE meeting. We'll go to that live.
States of affairs for our two variables, our two goal variables, call for different monetary policy responses. So, yeah, as they come more into balance, I think the idea has been that policy should move from being, tight to some degree to being more neutral as those two things balance out. But it is clear, though, that, if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then and talk about employment a little bit. We had Anna Paulson here yesterday, and she spoke about the break-even unemployment, or break-even employment growth rate. And that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably includes some numbers that might even be negative. Where do you see the monthly break-even employment growth rate at this point?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is, 50,000 plus or minus, something like that. And, that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal. And that's what's so challenging about this is that both supply and demand in the labor market have come down so sharply, so quickly. And the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving at roughly the same pace. Although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many, many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and what the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken, weeks, months, probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to move and to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later. The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly. But then those would eventually affect employment and inflation. So longer lags are when the research generally shows longer and longer lags for employment and inflation.
And I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data and employment. So in the employment space, there's some plausible data. I will say generally the private data, the alternative data that we look at, is better used as a supplement for the underlying governmental data, which is the gold standard. and it's not as it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting. So I think in job, in employment space, there's some pretty good substitutes, less so in inflation space and in economic activity space. And also they're just, they're different private data providers use different universes and different levels of rigor in their data analysis. So, we're looking at lots of things, and we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, and we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, the CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
I'm not going to comment on any particular asset price, including that one. And I think we think of inflation as driven by fundamental supply and demand factors, and it's not something we look at actively.
Fair. The September projections, we saw revised GDP growth projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue to issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic activity data which are surprising to the upside. And as I mentioned in my remarks, so you do have a bit of a tension there between the labor market data that we see, very low levels of job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that, but it does create, of course, if economic activity were stronger, then that would tend to support labor market activities and hiring. So we'll have to see how that works out.
Great. Another topic that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI, what plans are in place to assess its long-term impact on productivity, implications for labor markets, and overall economic stability? And does that present any new risks to monetary policy or financial stability?
So you're right. We're doing what other people are doing, which is reading all the things that, so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And, in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology showing up everywhere, but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself, because you would think of another big technological advance as potentially raising productivity, but I think it's early to say that we're seeing it. Also, you're seeing, I think some researchers have found effects on hiring from AI for entry-level people and for coders and things like that. So there's probably some of that out there, but it's just so early to say what it will be. We also monitor very carefully what public companies are saying. Increasingly bold statements from mainly large private companies on things that they think they can do across their whole business area with AI, and either sort of freeze hiring where it is or reduce hiring. And, I think we're pretty aware of what the potential outcomes are, but the range of potential outcomes is very broad. I will say, in terms of what the Fed can do, we deal with supply and demand. We have an interest rate, and we also do regulation, that kind of thing. But if what's needed is greater education and skills, I mean, I've always liked the model that technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, their work, which they actually spoke about at Jackson Hole this year, but it's a 20-year-old book that they wrote. So we can't do that. That's not something the Fed can do. We also can't address the potential societal disruptions that could happen, potentially, if there's really significant job loss. So there are a lot of, we're the least of it. There are potentially really significant implications for people in the labor force. And I think we're all speculating about what those might be, but it's only the beginning of this story.
Yeah. Looking at some of the other questions that are getting upvoted, and you can get as far into the weeds as you want, but this is where people want to go. So let me try this one. As you think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window, and so on?
So we have a nice spider chart and 5 main indicators, one of which is sort of repo levels. And I think overall what they're showing is that we're still at ample reserves. Abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves, a little bit above ample reserves. So, but we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
I think we're not going to get away without addressing this one. So I'll try to, again, group some of these together. First, there's definitely appreciation from the audience, your ability to try to remain above the political fray. And I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now. But with that ongoing scrutiny of the policy decisions of the Fed, what measures is the Federal Reserve taking, and are you taking, to ensure and demonstrate the continued independence in setting monetary policy?
So the main thing we can continue to do is to do our work the way we've always done it, which is, think really carefully about evolving economic conditions and the evolving outlook and the balance of risks, and try to make good decisions to best serve, the American public, and then explain those decisions and talk about them in a way that makes sense and is grounded in the data and our overall approach. I think we're going to keep doing that. And as long as we're doing that, people will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people. It's just not, that gets to be political sort of right away. So we just do our work and do it as best we can. I mean, overall, I would say the Fed comes through the last, if you think about it, go back to the beginning of the global financial crisis. We've had 2 world historical crises back to back, essentially. And the U.S. economy, it's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate and did innovate. There was really no choice. We can look back now and as I did today and second guess ourselves, which is only appropriate. That we've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think if you take a step back, the Fed is a government agency that does a good job for the public that it serves. And that is our only goal. And I think we do it pretty well. Don't look for perfection. You know, these are close calls that have to be made in real time. But I guess that's what I would say.
It's fantastic. And in that context, then internally to the FOMC, how important is it that you have consensus on it? I mean, we're economists. We understand the value of spirited debate, and but is that important in terms of communicating the results and the decisions of the committee?
I mean, consensus is great, but I mean, the most important thing of all is to get it right. And, you know, that you come to places, not very commonly, but sometimes you come to places where people are going to have different views, and this is one of them. You have a situation here where literally inflation's above target and gently rising. The labor market is subject to pretty clear downside risks. What do? How do you think about that? That's not a problem that you face very often in central banking or in the economy. And people are going to have different weights and different risk aversion and different risk appetites on those things. It would be kind of surprising if you had no debate over those things. So we have a healthy debate going on. I think it's very healthy. I think the meetings that we've been having are as good as any we've had, you know, in terms of people sincerely, you know, giving their absolute best argument for their positions, but they're different positions. That's, I mean, when I was an investor, I always felt like the most dangerous thing is if everybody agreed on something, because you need someone to come in and try to explain why this is a terrible idea. Hopefully somebody really smart. And that would give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised that we have people across the board. I do think we also, as an institution, do try to come together around you know, a central answer. And that's, of course, part of what I try to do is you know, find an answer that will attract as much support as possible.
Absolutely. I know you probably won't want to comment in great detail on global conditions, but there are a few questions around that and what that implies for U.S. monetary policy, and also just looking at the interest rate differentials between the U.S. and other advanced economies, and how long that could persist, and is there a risk there?
Sorry,
the interest rate differentials between the U.S. and other advanced economies.
Yeah, I mean, you know, we set interest rates according to, you know, the place where our economy is domestically, you know, taking into account the international aspects of our economy. So again, it's not surprising. I mean, you could name many factors, but, you know, for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more, I won't say heavily inflationary, but there's some inflationary pass-through to consumers from countries that are putting tariffs on. So there's a very different monetary policy response potentially just in that. So, you know, I think we need to set, as every other central bank does, they're setting rates in their, whatever their, you know, remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about, as we look back, and, you know, it's a momentous award, it's a nice time to reflect. If you looked back on your early career and your early goals, how do you think that young Jerome Powell would view where Jerome Powell is sitting today as chair of the Federal Reserve?
Surprised. No, I would say, so what I would tell young economists is you've chosen a great profession, a tremendous profession. You know, you're getting the tools to analyze public policy and what works and what doesn't work and what should be expected to work and wouldn't and why. And also what's the state of the economy. And guess what? It's not just hard, it's basically impossible. But it's a very, very difficult thing, but it yields itself up over time. And, you know, it's just an incredibly important subject that carries the capability to do really good things for the general public, who may not feel great gratitude toward economists, but sometimes. But no, it's really important. You've made a great choice, and I would say wish you the best of luck.
Thank you. Agree. Okay, we'll do a little bit of a lightning round here. We have about 5 minutes left, so I'll ask a bunch of questions that you may not want to get into great detail on anyway. Some of these are pretty straightforward, but so we talked quite a bit about labor markets, but we have not specifically asked the question about the effect of immigration policies on labor supply. How restrictive do you think that current policy is, and is that something that will just
current immigration policy?
Yeah.
Yes. Let me start by saying that we don't have a view on immigration. It's not our job to have a view. So we take that as completely, it is what it is. We take it as it arrives. More, I'd say, a stronger policy than most people had expected. We've seen very sharp decline in growth of the labor force and in people entering the country, and yeah, I think you're only beginning to see the strength of that policy too. There's more expulsions; those are rising, and that kind of thing. So yeah, that's a big economic factor. So that will mean fewer people to work. You have anecdotal evidence of industries that are just having a hard time finding people. You don't see it in wages or anything like that at this point. You don't see, at least in the aggregate, you don't. But yeah, it's going to be a really important economic fact because that's new people who come into the workforce. They create their supply, but they also create demand. They create their own demand, and again, from our standpoint, we're just our job is to achieve maximum employment or maximum sustainable employment. And that will depend both on the supply of workers and the demand for workers.
Back to the balance sheet, some questions. Again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly.
Fair. Question on the beverage curve. Maybe that's not a lightning round question, but let's try it. So do you think that the shift in the beverage curve is a structural shift or just a blip?
I think it's, you're at a place where, further declines in job openings might very well start to show up in unemployment. You've had this amazing time where you came straight down, and but I just think you're going to reach a point at which unemployment starts to go up, and we haven't really. We may be hitting that now, but it's been remarkable how that line it just comes down, and which has been really a great part of the recovery.
All right. Well, we have just a couple minutes left. I think we'll end with maybe another sort of philosophical question. Michael Barr spoke to the policy conference in 2024, I believe it was, and he gave some advice to economists. What would your advice be to the economists in the room in terms of how we can best serve the challenges that are facing us collectively in this moment?
I'm inclined to say keep your heads up. It's a time when people are challenging expertise, and I think it's a distinguished profession. It's a very high order profession, and you should be proud of your work and keep at it. Ultimately, we're learning about how the economy works and how society works. Our understanding is so basic and so uncertain, really, still after all these years. But you got to think we're making some progress and doing some good. and imposing sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say keep at it.
And likewise, NABE supports you.
Are we done?
We're done. Thank you so much.
Thank you. Thank you. Thank you very much.
Fed Chair Jay Powell, as you just saw, wrapping up a Q&A session at the National Association for Business Economics annual meeting in Philadelphia. And he says there isn't now a risk-free path for monetary policy. The Dow and S&P, meanwhile, have turned positive. The Dow is down more than 600 points at the low. The NASDAQ almost positive. The yield on the 10-year back below 4%, hitting the lowest level since September 17th. Let's get to senior economics reporter Steve Leisman for the biggest takeaways from the Fed chair. Is that the oddest couple that you've ever? I looked over and I said, that person looks like Cathie Wood. And then I looked closer and I said, that is Cathie Wood. Do you know what her Bitcoin forecast was for? Do you know what price, Steve?
No, I don't, Joe.
2.4 million by 2000. It just was, to me, the juxtaposition of Jay Powell with Cathie Wood was a little, did it strike you as a little bit odd or not?
They put some interesting pairings here at NABE is all I'll say.
I guess it's like, maybe it's like us.
Exactly. But we did pick the right ties this morning.
Yeah, we did. Look at that.
Right, exactly. And the right color suit. Look at you with a suit on, by the way, and a wake afternoon, which is unusual, of course.
Right.
Fed Chair Powell suggesting, I think it's interesting to go through the nuance on this, though. He suggested but didn't explicitly say that rate cuts are likely to continue. He told the NABE meeting that the Fed's outlook for employment and inflation have not changed much since September, when Fed officials were forecasting another 2 rate cuts this year.
Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals.
Powell said the Fed was using a range of private sector and still available government reports to gauge how the economy is doing in the wake of the shutdown. That data so far suggests higher downside risks for employment and inflation, mostly from tariffs, not part of a broader inflation problem. He also noted that data prior to the shutdown showed the economy on a firmer path with those better growth. Now, this may be something that excited the market because separately, Powell said the Fed may approach a point in the coming months where it stops reducing the balance sheet, or QT. 3 points he made about that. One, there's some signs that liquidity conditions are tightening from firmer repo and other things that the Fed's monitoring. The portfolio is overweight longer assets, underweight shorter term assets. And finally, the longer term, the portfolio should be primarily composed of treasuries. Last thing is Powell's comments were not a decisive endorsement of those future cuts. He just said the situation hadn't changed since September, and he did not lean against, Joe, this is important, lean against the market expectations, which, as you know, are pretty firm for those 2 cuts this year.
How can anything change when you're not getting any government data?
It's a good question. It's why I didn't expect much change at all in his outlook. Had there been a bunch of reports, had they surprised to the upside or the downside, it might have changed his view. But basically, they're going on the trajectory they were on, Joe. It's a bit like you're in a car and all of a sudden you can't see anything, so you just kind of keep the wheel straight. Well, that wheel showed that you had the downside risk for employment increasing, and you had inflation was mostly from tariffs and not broader. But we'll see next Friday, Joe, when we have that CPI report come out.
Well, the CPI report's not coming out, is it? That's what I'm saying. They're talking about November now, maybe, Steve, at least till after the, you got your plane ticket to the No Kings March. I think it's next Sunday. I don't think they're doing anything.
No, Joe, unless I missed something, Joe, and I'll take a look at this. There's a CPI report coming out October 24th. Did I not report that? Maybe I didn't.
Okay, and you think it's going to be done either way, even if the government's still shut, it's coming.
The reason the government said it's coming, Joe, it's interesting how politics gets into data. but it's because they need it to calculate the Social Security cost of living.
Right,
increase.
I know that. That's why I thought they had to reopen. I thought they had to reopen to do that, but they can do it without reopening?
Well, apparently they've called a bunch of workers back. And there is one interesting question, Joe, that I was listening to in the Q&A and in the speech, which is that September jobs report was done. And I'll just say there's a little scuttlebutt here in the hallways about, does Powell have that report? Does the Fed have that jobs report? We don't know that. He didn't really let on, but we kind of think he maybe sort of does have it.
Wow. All right, Steve. Yeah, I was just trying to get to the government, whether you know whether it looks like November now or what. So we won't get we'll get certain things here and there. And they've got some other anecdotal evidence, numbers that they can use from time to time. Right, Steve, do you?
Yeah. Well, I'm actually working on, we have an inflation report that could be a proxy. I have another way of getting jobless claims. I'm doing overtime on this, Joe, trying to find the private sector data, and I'm doing it all for you, Joe, because I want you to have the information. I'm going to hopefully have it. We're going to have a jobless claims proxy. I'm working with my friend Nick Wells at CNBC on the inflation story, and we have the ADP data. So we're trying to, what's the right way? We're trying to paint a picture with our claws here.
All right. Very good, Steve. Yep, a great outfit. I mean, that obviously great minds.
How can you lose?
Dom is laughing. Let's chat some markets. I saw Dom, and I immediately want to know, okay, Caterpillar. So
it's up like 4.5%, 5% at this point.
Like 25 points. So the Dow was down 600. So now it's up 300. And Goldman Sachs is still down, I think, double digits. So you do the divisor on all these. If Goldman Sachs down 10,
70 points. Yeah.
Some things are up.
Sure.
Home Depot, I think, is up too. Did you look for me?
Yeah, Home Depot is up there. I think Disney shares, I want to say,
up a little.
They were up a little bit as well. If you take a look at the overall picture for the Dow right now, though, it is the outperformer. We've seen that 900-point swing at this point because we're at session highs, up roughly 300 and some points at this point, the last I checked. The tech-heavier NASDAQ is still the laggard right now for some of those obvious reasons. But the reversal that we've seen so far during the course of the day has been notable only because we were looking for this consolidation phase that was supposed to be playing out over the course of the last few days, especially since Friday. It was a potential catalyst for at least some people to say maybe there is still risk out there and it's something that we want to pay attention to. But other folks used it as a way to say buy at some discount prices. Now, the S&P 500 got all the way on an intraday basis down to that 50-day moving average, the 50-day rolling kind of medium-term price trend for the markets overall for the S&P, and we bounced off those levels. So as you kind of look at what the path of least resistance is, there's still a feeling like people want to step in and buy the bid, no matter how, or buy the dip, no matter how much it is, and maybe they'll stay that way.
I guess infrastructure play is one of the brokerage firm's favorite was Caterpillar, so that's up. American Express is up almost 12.
So,
and Home Depot up 7. So right there, maybe we're.
Well, and it's not just that as well. If you take a look at the reasons why the trade story with China is the main catalyst for the downside volatility that we've seen. If you now start to believe that there are reasons for you to be somewhat optimistic, we've seen the story play out before. Volatility has been there for trade over the course of the last couple of years at this point now, and every single time some downside draft has happened, eventually things end up working themselves out. The president himself alluded to it over the weekend, right? Saying that, things are going to get better. Don't worry about China so much. This has been a blueprint for a lot of investors over the course of the last several quarters at this point with regard to trade, China, the U.S., and just the market volatility that can go along with it. Now, what we haven't seen up until Friday was that kind of move play out pretty much since around late spring, right? Around the so-called Liberation Day lows, right? That was the real reason why people were caught a little bit off guard, but they then remember what happened in the wake of that and say, maybe this is the way it's going to work out again in the future.
Right. Were you scheduled on?
No. Well, I was scheduled to be on with you later on to provide an update on some of the stock movers out there.
Well, you're welcome back, but thank you, because I wanted to talk.
Well, I always we get to talk
things
over
turn around
computer screen.
Yeah, we do, and I usually don't see you. That's close. Where are you when you're with it? Are you out here in the morning?
Yeah, I'm right over here. You can't really see it over here offset.
Everything looks different out here.
Studio A is very big, though, compared to the NASDAQ in terms of the studio size. But that's where I would normally be, right by the telestrator behind me right now, Joe.
Peacocks.
You noticed that. The main newsroom one is gone.
No, I don't think anyone heard what I said out there. But so people have noticed? All right.
People have noticed.
Because we're versant, baby.
There
And
you go.
I'm proud to be. My next guest says the bull market is rolling on, and there's good reasons for that to continue. Joining me now, Andrew Slimman, Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, the first thing you say is that you're worried about the bubble in the non-profitable tech stocks. I thought that was the difference this time versus 1999. There aren't that many non-profitable high flyers. I mean, they're profitable, most of them, aren't they? Are they just rich in valuation?
Well, you chose the, hey Joe, you chose the peak of the internet bubble in 1999. I don't think it's comparison. The move up in the nonprofit tech stocks in that era was 400%. The move up now is like 100%. So we're on our way, but I think it's too premature to say this is 1999. But to be clear, that is the number one thing that worries me. I am worried about the speculative stocks are leading the charge. Look, today they're up again strong, and that's a warning sign. So I love Friday when the market pulled back, they got hit. That to me extends the bull market cycle. The more money that goes into these stocks, the more it worries me the duration of the bull market.
But the Mag 7, they're all profitable, aren't they?
Correct.
Okay,
right.
so you're
we're not talking about those stocks, Joe. We're
Which
not
ones?
talking about them.
And you're not talking about you're not talking about like large language. You're not talking about LLMs or private companies.
Quantum computing, nuclear stocks, flying cars, crypto. You name it. It's the losing. Yeah, it's the speculative ones.
Speaking of flying cars, Cathie Wood was just on interviewing Jay Powell. I mean, I don't think she asked him about the flying taxis yet, but I thought that was interesting. So you like when you see a little deflation? I'm talking about in the bubble. You see the bubble deflate a little, and you step right in. Is that?
I think it's great. That's what we need. But because take a step back, Joe. On the positive side, if I said to Joe, don't overthink this. The Fed is cutting. That means monetary policy is friendly. And by the way, the one big beautiful bill, there's going to be a lot of tax savings next year. So fiscal policy is friendly too. Those are two very powerful things driving the market. Don't overthink it, right? The one thing that hangs out there is this kind of feeding frenzy in speculative stocks. But other than that, I think it's a very bullish backdrop.
And it is not, as far as sentiment goes, we are not overly bullish right now. It's not really a loved market yet.
It's amazing to me. It's amazing to me that's the case. And then, but the pushback, Joe, is people say, well, the market's expensive. And I say, well, what do you want? The market's in the fourth year, it's moving into the fourth year of bull market. You got fiscal monetary policy friendly, sentiment isn't too high. I mean, you can't have everything. Yeah, the market's a little rich. But other than that, I think there's some very strong reasons to remain optimistic, with the exception of these speculative stocks.
You know what we didn't used to hear? People talking about the OBBB, but you know what you haven't mentioned? It's not even in the notes anywhere. I don't see any word to begin with T, in fact. Why aren't you?
Paris.
Yeah. It's so first half of the year.
So first half of the year. But I think one of the things that people forget is that a lot of the tax benefits to corporations offset tariffs. So look, my point of all this is we always try to expect, okay, what's the unknown that's going to happen? Well, the reality is we had an unknown, and look what happened. The froth came out of the market on Friday, and it started off that way today, and then you get Jerome Powell, talking about cutting rates, and right back to the speculative stock. So I know what the leadership is, but be wary when unknown things like a new tariff tweet comes along. That's what's going to get hit.
So, Andrew, we know that currency fluctuations, when they're favorable for a company, they kind of say, yeah, that's good. When they're not favorable, they say, well, it's fine. It was just, it's not our fault. It's the dollar. But the dollar's been weak, but it's moderated recently. How's that going to play into the earnings outlook after this quarter?
Non-event. I just don't think it'll be an event. Now, it's been a big event in terms of people's allocation, because the dollar went down the first half of the year. The rest of the world did better, especially Europe, and everyone thought, oh, this is the opportunity to invest elsewhere. And I kept going, yeah, but you really want to take your money out of the U.S. to go to Europe where there's very little technology. They're not benefiting from the AI trade. And ever since then, the dollar's moderated and the U.S. has outperformed Europe. So, I just don't think the dollar's going to impact earnings this quarter. But overall, I think it's going to be a good earnings season.
All right, Andrew Slimmon, Morgan Stanley, thank you. Got to get to trying to think of how valuable or what I can call you. I can call you the sixth man, although you're a woman and there's only 3 people on Squawk Box, but you're so valuable this morning.
Thank you.
Because we've got a lot going on and these banks come fast and furious. There's 15 metrics to look at probably in every one of them. Is there not?
There are definitely 15 or more metrics to look at.
You need to know what analysts are expecting versus what the company posts. And you're right there like Johnny on the spot. So go, Joni. I don't know.
I was picturing a porta potty, but...
No. Yeah, that's right. I forgot about this. Goldman Sachs is still down. $10, I think. Yeah.
Yeah, Goldman.
Go across. Tell us about all of them.
So Goldman is down because they missed expectations on expenses. You also have lower shares for JP Morgan as well, and that largely has to do with a miss on net interest income, as well as some higher provisions for loan losses. But Citi and Wells Fargo, those 2 performers are the standout this morning for really idiosyncratic reasons. Wells is higher. That one is up, let's see, about 7.7% right now after hiking their medium-term return on tangible common equity to as much as 18%. That's up from just 8% nearly 5 years ago, so a more than doubling of that efficiency metric. Citigroup shares also getting a boost after that firm saw revenue growth and record Q3s in each of its 5 businesses. The firm also beat on net interest income. That's the profitability metric for loan making, and is setting aside less than expected for potential credit losses. So kind of the mirror image of what we saw with JP Morgan in the quarter. Now, overall, credit metrics looked pretty sanguine despite concerns over 2 auto bankruptcies in recent weeks. One of them, Tricolor, resulted in $170 million of charge-offs for JP Morgan. Now, that's a pretty small amount for a firm of JP Morgan's size, but Chairman and CEO Jamie Dimon was asked about it on the analyst call earlier.
My antenna goes up when things like that happen, and I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one. And First Brands I'd put in the same category, and there are a couple other ones out that I've seen that I put in similar categories. So, but we always look at these things, and we're not omnipotent. We make mistakes too. So we'll see.
Yeah, so Dimon also went on the call and talked about how they're reviewing their processes and their underwriting standards and always looking to improve on different metrics of that sort. But a lot of questions about credit quality, a lot of questions about the interconnectivity between private credit and the banking system on pretty much every call we saw this morning, Joe. JP Morgan,
So if you had to say one thing for it's done well. I mean, do you know anything else to say why the stock is off a little bit today?
Yeah. Oh, well, they can't buy back stock. At least that's a question that's asked every single quarter. And Dimon always says, why would we buy back stocks at these levels? I mean, it's just
3 times book almost.
Yeah, it's
what, 2.5?
Yeah, exactly. About 2.5 at this point in time. So, from his perspective, why would we buy back stock when it's this expensive? Now, he doesn't want the stock to go down, but in terms of use of capital, which has been a big overarching question in recent quarters because you've seen capital levels presumably increase with the rollback of some of the regulations that were causing them to have more capital. So, are you going to use it for M&A? Are you going to use it for buyback? So far, we haven't seen too much in new use cases for capital, but that's certainly a question that pops up every quarter.
Is anyone below 1 right now?
I believe Citi is still below 1.
Still below 1.
Still below 1. But it is the best performer year to date of the Big Six.
It's a big turnaround.
It's really chugging along.
Multi-year turnaround.
Working its way up there.
All right, thanks.
See you tomorrow.
Who's tomorrow?
Bank of America, Morgan Stanley.
Okay.
And I'll be with you at the NASDAQ.
You'll be down there.
I will. I know.
Awesome.
Just when you thought you were sick of bank earnings, we're coming back.
No, I'm pretty sure I'm sick of them. No, I'm not. No. I'm looking forward to that tomorrow if you're doing them. Coming up, Bitcoin hovering around 112,000, down more than 10% from last week's record high. We'll look at what the next catalyst could be to get that crypto trade back on track. Plus, trade tensions with China back on the rise. You saw that with the rare metals. And the government shutdown turning 2 weeks old. Who knew? We're going to round up the latest from Washington. The Exchange is back after this.
This is The Exchange on CNBC.
crypto's improved a little, but still in the red. Stocks making a strong recovery. Bitcoin down more than 2% and hovering below 113,000. Solana and Ether also under pressure. Let's talk what's next for crypto with our panel. Meltem Demirors, Crucible Capital General Partner, along with Matt Hogan, Bitwise Asset Management CIO. Meltem, can you tell me about last week and exactly what happened on that day? It almost looked like margin selling. What was that from?
Leverage is a hell of a drug, Joe. That's what I can tell you. What we saw is cascading liquidation 2.0. We saw this in 2022. In 2022, it was borrowers that were off-chain. This time, DeFi functioned exactly the way it was supposed to. There were some liquidations happening, triggered more liquidations, and we saw a $19 billion liquidation cascade. Again, leverage is a hell of a drug.
Matt? Meanwhile, gold has, at least in recent sessions or recent months, has proven itself as non-correlated, rush to safety, all the things that Bitcoin bulls aspire to for the crypto trade one of these days. It's not here yet.
Yeah, I think it's here depending on your time frame, Joe. Yes, Bitcoin has been more volatile than gold. Gold is ahead of it right now, but I think gold's going to drag Bitcoin up. If you pan out over the last year, the debasement trade has been Bitcoin and gold. They've taken turns leading. Gold's ahead right now, but I think we're going to see a strong end of the year. So I wouldn't count Bitcoin out.
You can talk, Meltem, about, I'm not in a position to understand Solana and some of the other, when I get done with Ethereum and Bitcoin, then we're in Dogecoin type territory for me. They all move in tandem though, right?
Well, they used to, not so much anymore. I think what we're seeing is we used to view the crypto market as sort of one market. Bitcoin dominance, right, is still over 50%. So historically, things have really moved in tandem. When Bitcoin runs, alts will catch up and we'll see sort of the whole crypto complex run. I think this is the first time, this is year 11 in crypto for me, that there's no longer one crypto cycle. There's Bitcoin, there's altcoins, Ethereum, Solana, the high caps, and then there's everything else. So I don't think we have the same correlation we saw before. So it's no longer market beta of one. There's different subsectors in crypto.
Matt, we got our ETFs, we got our institutional, starting to see increasing ownership move in that direction. I don't know, is there another halving? What's on the horizon? Maybe some government, maybe finally getting some domestic regulation or clarity on what it's going to look like. What's next for Bitcoin?
So for a short-term catalyst, for sure, progress on the Clarity Act in Congress, if we see that, if the government reopens, would be positive for crypto. But the real bull story for crypto is just the slow-moving freight train of institutional investment. I've probably done a half dozen meetings with institutional investors and financial advisors over the last 2 days. None of them talked about what happened over the weekend. None of them talked about the liquidations Meltem talked about. They talked about this need to get exposure to crypto. They're currently on 0. They're going to 5%. That's the big story. It's a slow-moving bull market, but it's a very strong, long-term bull market from my view.
Very good. Thank you, Matt Hogan, Meltem Demirors. Coming up, we'll go a long way from crypto back to almost what is a blue chip again in a big way, GE Aerospace. Shares up 80% this year. I think it was one of the big gainers today as well. In fact, yeah, it's up $4, $3.71. Now the company's announcing a multi-million-dollar investment into workforce training. Our Morgan Brennan sat down exclusively with CEO Larry Culp and joins us next with her exclusive interview. The Exchange is back after this.
Welcome back to The Exchange. I'm Kate Rogers with your CNBC News update. A federal judge has ruled the Trump administration violated a previous court order on FEMA grant funding. The judge said Homeland Security did exactly what his ruling forbade when it imposed new conditions on states before they received emergency grants from FEMA. The judge ordered those conditions be removed by next week. Israeli officials said today the flow of aid into Gaza will be reduced in half, and the Rafah border crossing between Gaza and Egypt will stay closed through Wednesday. The decision comes after Israel said Hamas has been too slow turning over bodies of deceased hostages. So far, only 4 of 28 have been released. Hamas previously said locating the bodies has been difficult. And AMC Theaters is re-releasing the film's Annie Hall and Something's Gotta Give in tribute to the late actress Diane Keaton. Multiple outlets reporting the movies will be shown in 100 of AMC's theaters nationwide for a week starting Friday. The Oscar winner died unexpectedly over the weekend. The Exchange is back after this.
Welcome back to The Exchange. Renewed U.S.-China trade tensions adding to the wall of worry as we enter day 14 of the government shutdown. Our next guest says that President Trump is focused on geopolitics right now, but his attention may be needed here at home to break the shutdown impasse. Joining me now is Tobin Marcus, head of politics and policy at Wolfe Research. We saw Friday. We understand how important China is, and we can do a lot of we could even do India in terms of trade deals, but the big elephant in the room has always been China, Tobin, and it's been kind of a Tolstoy novel, watching what's going on, citing a Russian, but started out in March, looked bleak, a lot of, really bellicose language back and forth on trade, and then everything's sort of quieted down. What happened after that initial détente that we reached? Did we add some export controls? What caused China to do that with the rare earth, with the rare materials?
So, I think there's multiple motivations for the move that we saw last week to dramatically expand their rare earth export controls. It is, on the one hand, they positioned it as retaliation for some U.S. moves, both these new fees that we imposed on Chinese vessels at ports, but I think more importantly, our expansion of what's called the entity list to apply it to subsidiaries also, which effectively applied U.S. export controls to thousands more Chinese entities. They were pretty upset about that. They thought it broke the kind of informal understanding that neither side was going to be doing new restrictive stuff after the last round of talks in Madrid. So that's one motivation, but I think it also is something they've clearly been planning for more than just a few weeks. So I don't think it's just a response to that. I think it's an effort to add pressure to the U.S. To try and get the tariffs fully removed. These sort of truces that we've managed to get in place since May are still somewhat asymmetric. Like the tariffs that we have on them are much higher than the tariffs they have on us. And I don't think they're fully satisfied with what they've been able to achieve so far.
Well, that was the rare earth materials and the way that they instituted those controls at, 0.1%. I mean, that was a shot across the bow. People characterized it as almost nuclear war on an economic front. So they had to expect something like Trump's response. I was surprised that it softened so much over the weekend. Are we really, is it all just theater between both countries?
So I certainly don't think it's theater. I think Trump is trying to project calm towards an outcome that we don't have yet. I think there's a clear commitment to talk. We have staff level talks have resumed already. I think both sides sort of realize after getting through that period in April that it's not sustainable for anyone to have sort of catastrophic.
So you expect a positive outcome, but at the same time you point out it's as tenuous as it's been since March.
Yeah, that's exactly right. It's not theatrical in the sense that there is an actual issue. It needs to actually get solved. But I do think that we will probably get there. I think getting there gets us back to a truce. I don't think that we're, really within sight of this sort of big deal that lots of people have been speculating about going back to last year. Maybe we can get some huge Chinese investment, get the tariffs fully removed. That looks pretty remote to me. But I do think we'll be able to get the truce.
Quickly on the shutdown, you think it's a mistake for Republicans to go with really large layoffs and closures of agencies? That comes back.
I do.
You do?
Yeah, so I think on the one hand, it's something that the administration has shown they don't really want to do. I mean, they ordered agencies to prepare for these massive reductions in force way back in February when DOGE was at its peak. They haven't really gone through with that. So I think that goes to show that they see some risks there. But from my perspective, right now, the shutdown is not really impacting people. You have things starting to show up, like air traffic delays from air traffic controllers doing stickouts because they're not getting paid. But for the most part, it's something that markets and ordinary people are able to shrug off. If you use this as an excuse to go and start like truly large scale firings that really are optional, I think that both takes ownership of it in a different way and sort of creates self-inflicted consequences in a different way. For now, I think Trump is happy sort of riding high on peace deals, confronting this emergent situation on China and letting Democrats spin their wheels.
All right, Tobin Marcus, Wolfe Research. Coming up, shares of GE Aerospace are up about 70% just since President Trump was elected. We're going to hear from CEO Larry Culp in a CNBC exclusive on the state of demand and where the company is investing to meet that demand. That's next. That's not possible. I know we're here. No one's going to die. Recent data showing weakness in the who's this guy in the labor market, but one area where workers are in high demand, advanced manufacturing. We were just talking. Larry Culp's been there 7 years.
7 years, October 1st. Stock, by the way, up 11-fold since he took over.
11-fold.
11-fold. I realize we've got 3 different companies now, but just
I was lucky
put that in
enough,
perspective.
and you sat down with him, and you're Morgan Brennan.
I'm Morgan Brennan, and Joe Kernan. It's good to be sitting here with you.
Good to be sitting here with you. People are panicked in there, so they're not used to the squawk box model.
All right, well, we're bringing the morning to the afternoon here.
Exactly.
I spoke with CEO
Maybe
Larry
not.
Culp, as we just told you, about the skills training program that GE Foundation just announced this morning. Joining me earlier from the company's Cincinnati Training Center, Culp noting that the investment is not just about feeding the engine manufacturing pipeline at GE Aerospace, but also about getting more workers into more jobs throughout the aerospace supply chain. I asked Culp why this is so necessary and what it signals about the need for highly skilled workers as the broader labor market shows signs of softening.
It's necessary because, as you all know, the industry at large was really laid bare back in the pandemic, and we've seen this wonderful rebound in demand, not only from the airframers as they ramp new airline production, but from the airlines who need more parts and services, while at the same time we have our defense customers around the world raising their own expectations. So we feel that at GE Aerospace, we're in pretty good shape. We've got 53,000 people on our team today. More than half of those work in manufacturing operations. We'll bring on another 5,000 this year. But what we really want to do is make sure that we're touching anyone and everyone who can be a part of this industry-wide ramp, particularly those who could work for a sub-tier, a tier 2, a tier 3 supplier who are critical components of our overall supply chain.
It's interesting that we're having this conversation right now as there's this bigger, broader debate in the markets about the softening of the labor market. And it sounds like the read-through here is that looking across the industry, there still aren't enough of these highly skilled workers.
Morgan, that's exactly right. And again, we've got this wonderful opportunity where our customers are looking for us to increase our supply between now and the end of the decade, when we're virtually sold out in that regard. So we need to do more every quarter. We need to do more every year. In turn, we need the team in place to be able to help us here at GE Aerospace across our supply base. And it really is an industry-wide effort. We're doing our part with this $30 million announcement that we're making today in workforce development, but it's something I think all of us across the industry need to take on.
Now, Culp also telling me he continues to see, quote, very strong demand from the airframers, meaning Boeing, Airbus, and that he thinks GE will, quote, be challenged to keep up with their expectations. That said, supply chain continues to improve. We'll probably hear more about that next week when GE reports earnings. Also, Culp saying that GE is using AI not only to improve manufacturing and servicing of jet engines, but also, Joe, to help train these workers. We talk about whether AI is going to replace jobs. When it comes to factory jobs and servicing jobs and shop floor jobs, those are not going anywhere. Those probably get more valuable, which is a point that he made to me in this conversation. You can catch the rest of the interview on Closing Bell Overtime. That's going to be kicking off at 4 p.m. Eastern.
Did you save the best for Closing Bell Overtime?
It's all great. It's all killer, no filler.
Tell me again, okay, so if you add all the constituent parts back together, how much is, because I know GE well, because I wrote it all the way down. Obviously, GE used to own CNBC. Can you,